Yo, what is up, guys? Hello, everyone. Welcome to reading day 1. Reading The Random Walk Down Wall Street. I forgot who the author is. By Melkill Norton. I think he's a professor at Princeton, finance professor at Princeton. And he wrote this book that I feel like a lot of people have heard about. And I've read through some of the first few chapters. I'm currently on chapter 7. I think it's going to talk about how well fundamental analysis is, which is pretty much what we've been doing so far. And wondering if I'm excited to kind of hear what his thoughts are and his survey of whether or not fundamental analysis works. So this is kind of a break from the previous streams, economics maxing, stocks maxing, where we've been looking at stocks and how the economy works. Today I'm just going to be reading a little bit and getting some other perspectives on kind of how the investments industry works. So I'm going to create I'm going to create a flashcard deck and a walk down Wall Street. Yeah, if I don't say anything that's super coherent, I'm very tired right now, and I didn't want to do this stream at first, but I think it'll be good for me to do something that I don't want to do instead of just lying in bed and watching YouTube. So here I am. Also, I do think that this is okay, so this is good so far. Close this for now. Alright. Let me create a deck. Chapter 7. How good is fundamental analysis? Okay, add this here. All right. So let's start reading then. John F. Kennedy after the Bay of Pigs fiasco. Okay. In the beginning, he was a statistician. He wore a white starched shirt and a threadbare suit. Put on his green eye shades, sat down at his desk, and recorded meticulously the historical financial information on the companies he followed. That's correct. But then a metamorphosis set in. He rose from his desk, bought blue button-down shirts and gray flannel suits, threw away his eye shades, and began to make field trips to visit the companies he had previously he had known only as a collection of financial statistics. His title now became security analyst. Suits were out, and Gucci sweaters and Armani slacks were in. He even wore designer sweaters while on Zoom during the COVID-19 pandemic. They were so incredibly brilliant and knowledgeable that portfolio managers relied on their recommendations, and Wall Street firms used them increasingly to cultivate investment bank clients. They were now equity research stars. Some, however, whispered unkindly that they were investment banking whores. Whoop. Okay, so it seems like my screen froze. I think it freezes about 5 minutes into the stream. Okay. At heart, the Wall Street pros are fundamentalists. The really important question is whether fundamental analysis is any good. The individual investor has scarcely a chance against the professional portfolio manager and a team of fundamental analysts. Many in the academic community sneer at such pomposity. Some academicians have gone so far as to suggest that a blindfolded monkey throwing darts at the stock listings can select stocks which with as much success as professional portfolio managers. They have argued that fund managers and their analysts can do no better at picking stocks than a rank amateur. This chapter will recount the major battle in an ongoing war between academics and market professionals, explain what is meant by the efficient market hypothesis, and tell you why it is important to your wealth. Are security analysts fundamentally clairvoyant? I think clairvoyant means that they have some type of psychological ability to predict the future. Okay. So that is similar. Predicting the future. Okay. According to, let me also make sure I got this guy's name right. Makio. Random walked Wall Street. So this is the one I have. Who's Andrew Tobias? Okay, so according to Burton, male kill. Are walls where most people, what type of maybe how does Burton Maykill describe the theory that powers Wall Street? Wall Street's an overwhelming majority of Wall Street believes in the idea of are fundamentalist, meaning they can value a company, they can accurately estimates the value of a company using financial data. Forecasting future earnings is the security analyst's raison d'etre. What does raison d'etre mean? Okay. What is the most important role of a security analyst? According to Burton May-Keel, forecasting future earnings. To predict future directions, analysts generally start by looking at past earnings. A proven score of past performance and earnings growth is one analyst only a most reliable indicator of future earnings growth. If management skill is really skillful, there is no reason to think it will lose its Midas touch in the future. If the same adroit management team remains at the helm, the course of future earnings growth should continue as it has in the past, or so the argument goes. While it sounds suspiciously like an argument used by technical analysts, fundamentalists pride themselves on the fact that it is based on specific proven company performance. Calculations. So such thinking flunks in the academic world. Calculations of past earnings growth are no help in predicting future growth. If you had known the growth rates of all companies during, say, the 2010 period, this would not have helped you at all in predicting the growth they would achieve in the 2010-2020 period. This startling result was first reported by British researchers for companies in the United Kingdom in an article charmingly titled Higgledy-Piggledy Growth. Learned academicians at Princeton and Harvard apply the British study to U.S. companies, and surprise, the same was true here. Let's take a look. What is this? Higgledy-Piggledy growth. Corrections must be made to earnings and dividends for capital charges. Changes are very laborious and could have probably been done without the cooperation of some researchers, for which I am most grateful. IMD little. Bulletin. Do they grow or decline by chance? So I keep looking at the skewness and kurtosis. I keep hearing about that. I think it would be helpful to understand what that means. Okay, so I think what I'm gonna do first, real quick, is I'm gonna come back to the book, but I also want to get my headband because my hair is getting my face. It's kind of annoying. I'm back. Now I look like a doofus. That's okay. So it seems like he's making the big argument that a lot of growth in the past, maybe financial data in the past, doesn't really help predict the future. And that seems to be a common belief in Wall Street that past results are indicative of future results, but there is no reliable pattern. Even during the boom years of the 1990s, only 1 in 8 large companies managed to achieve consistent yearly growth. Analysts can't predict consistent long-run growth because it doesn't exist. Good analysts will argue, however, that there's much more to predicting than just examining the past record. Some will even admit that the past record is not a perfect measurement, but that skilled portfolio analysts can do much better. Unfortunately, the careful estimates of security analysts based on industry studies, plant visits, do little better than those that would be obtained by simple extrapolation of past trends, which we have already seen are no help at all. Indeed, when compared with actual earnings growth rates, the growth estimates of security analysts were actually worse than the predictions from several naive forecasting models. These findings have been confirmed in several academic studies. Financial forecasting appears to be a science that makes astrology look respectable. Amid these accusations is a deadly serious message. Security analysts have enormous difficulty in performing their basic functions of forecasting earnings prospects. Investors who put blind faith in such forecasts in making their investment selections are in for some rude disappointments. So, I like how this guy, Burton Malkiel, he kind of says that financial forecasting is similar to astrology. Damn, that hurts. Why the crystal ball is clouded? It is always somewhat disturbing to learn that highly trained and well-paid professionals may not be terribly skilled at their calling. Unfortunately, this is hardly unusual. Similar types of findings exist for most groups of professionals. There's a classic example in medicine. In a time when tonsillectomies were very fashionable, the American Child Health Association surveyed a group of 1,000 children 11 years of age from the public schools in New York City and found that 611 of these had their tonsils removed. The remaining 389 were then examined by a group of physicians who selected 174 of those for tonsillectomies and declared that the rest had no tonsil problems. The remaining 215 were examined by another group of doctors who recommended 99 of these for tonsillectomies, when the 116 healthy children were examined a third time. Similar percentage were told their tonsils had to be removed. After 3 examinations, only 65 children remained who had not been recommended for tonsillectomies. These remaining children were not examined further because the supply of examining physicians ran out. Shown similar results. Radiologists have failed to recognize the presence of lung disease in about 30% of X-ray plates they read, despite the clear presence of the disease on the X-ray film. Another experiment proved that professional staffs in psychiatric hospitals cannot tell the sane from the insane. That's kind of scary. That is pretty scary. So, the point is that we should not take for granted the reliability and accuracy of any judge, no matter how expert. When one considers the low reliability of so many kinds of judgments, it does not seem too surprising that security analysts, with their particularly difficult forecasting job, should be no exception. There are, I believe, 5 factors that help explain why security analysts have such difficulty in predicting the future. These are the influence of random events, the production of dubious reported earnings through creative accounting procedures, errors made by analysts themselves, for the loss of the best analysts to the sales desk or to portfolio management, and 5, the conflicts of interest facing security analysts at firms with large investment banking operations. Each factor deserves some of their discussions. Okay, so let's continue going. Let's kind of dive a bit deeper into the 5 different reasons why. Okay. I'm gonna add another flashcard here. According to Burton Maykiel, it's almost 3. I think probably spend another 30 more minutes on reading, and then I gotta get started on working on a project for school and also studying for one of my exams. But I'm going to add something here. So the author, let's say this. What does Burton Maykiel say about long-term growth? About long-term consistent growth doesn't exist. Prime examples are IBM, I think Nortel Networks. These were the companies, I think Nortel Networks may not exist. Maybe it does. Okay, it got absorbed into maybe AT&T. But what he claims is that these were companies big in the 70s, 80s. They were kind of the Apples, the Microsofts of today. And apparently none of them are really around anymore. None of them, they are still around, but the growth rates that they had in the past, they're nowhere near to what they are today. Oh. Yes, Andre. We should. Yeah. I think I'm probably gonna study a little bit later, maybe 6, 7. I'll type in the chat, in the Discord chat. I just realized you can hear me too, I think. At 7. Yeah. Okay. Nortel Networks. Xerox. These were darlings in the 1970s, but no longer post-1980s. So in 10 years, these guys were at the top of the game. I think they were called the Nifty 50, and after 1980s, all of them just kind of fell apart. What are the 5 factors that Burton Maykiel thinks? What are the 5 factors that Burton Maykiel? What are the 5 factors that Burton Maykiel describe the? Think contributes to analysts not making great predictions about future growth. So I think the first factor is the random nature of events. Second is reported earnings can be crafted. Third, errors by the analyst. fourth, loss of the best analyst, so loss of best analyst to sales or portfolio management. And I think 5 is conflicts of interest. Okay, so those are the 5 important factors that I think Burton believes why analysts really have a hard time of predicting the future. One of the most important changes that affect the basic prospect for corporate earnings are essentially random, that is, unpredictable. The utility industry is one of the most stable and dependable group of companies, but in fact, many important unpredictable events made earnings, even for this industry, enormously difficult to forecast. Unexpected, unfavorable rulings of state public utility commissions and unpredictable increases in fuel costs often make it impossible for utilities to translate rapid growth and demand into higher profits. Forecasting problems have been even more difficult in other industries. As we saw in Chapter 4, growth forecasts made in early 2000 for a wide variety of high-tech and telecom companies were egregiously wrong. U.S. government budgetary, contract, legal, and regulatory decisions can have enormous implications for the fortunes of individual companies. Right. There's also a government and political side to this too. So can the incapacitation of key members of management, the discovery of a major new product, a major oil spill, terrorist attacks, the entry of new competitors, price whirls, and natural disasters such as floods and hurricanes. The biotech industry is notoriously difficult to forecast. Potential blockbuster new drugs often fail phase 3 trials because of failure to improve mortality because of unexpected toxic side effects. The examples of unpredictable events affecting earnings are endless. Okay, yeah, it seems to be the biggest problem. A lot of shit just happen randomly, so there's no way to actually forecast or predict that. The production of dubious reported earnings through creative accounting procedures. So this is the second reason why making forecasts is difficult for analysts. And a firm's income statement may be likened to a bikini. What it reveals is interesting, but what it conceals is vital. I like it. I like this. What does Burton me kill? Wait, am I spelling his male kill? What does I say that a firm's financial statement is like? He claims it's like a bikini. What it reveals is interesting, but what it conceals is vital. That's pretty good. Enron, one of the most ingeniously corrupt companies I have come across, led the beauty parade in this regard. Alas, Enron was far from unique. During the great bull market of the late 1990s, companies increasingly used aggressive fictions to report the soaring sales and earnings needed to propel their stock prices upward. In the hit musical, The Producers, Leo Bloom decides one can make more money from a flop than from a hit. He says it's all a matter of creative accounting. Bloom's client, Max Bielstock, sees the potential immediately. Max fleeces buckets of money from rich widows to finance a Broadway musical, Springtime for Hitler. He hopes for a total flop so that no one will ask questions about where the money went. Actually, Bloom doesn't begin to match the tricks that have been used by companies to pump up earnings and to fool investors and security analysts alike. In Chapter 3, I described how Barry Minko's late 1980s carpet cleaning empire, Zbest, was built on a mosaic of phony credit card billings and fictitious contracts. But accounting abuses appear to have become more frequent during the 21st century, failing dot-coms, high-tech leaders, and even old economy blue chips all tried to hype earnings and mislead the investment community. Here's but a small number of examples of how companies have often stretched accounting rules like taffy to mislead analysts and the public as to the true state of their operations. Barry Minko. That's funny. It's crazy that he was a passer at some point too. Barry Minko. Okay. In September 2001, Enron and Quest needed to show that their revenues and profits were still growing rapidly. They figured out a great way to make their statements look as if business was proceeding well. They swapped fiber optic network capacity at an exaggerated value of $500 million, and each company recorded the transaction as a sale. This inflated profits and masked a deteriorated position for both companies. Quest already had a surfeit of capacity, and with an enormous glut of fiber in the market, the valuation put on the trade had no justification. So does that mean they just sold each other the value? They just sold each other $500 million worth of stuff. Motorola, Lucent, and Nortel all boosted sales and earnings by lending large amounts to their customers. Many of these accounts became uncollectible and had to be written off later. So what does that mean, lending large amounts? Not sure. Xerox boosted its profits in the short term by allowing its overseas units in Europe and Latin America, as well as in Canada, to book is one-time revenue, all the cash to be paid over several years for long-term copyright leases. I see. So they kind of had this idea of deferred revenue that is a liability, which shouldn't be revenue that hasn't accrued yet. Then there was the pension gambit. Many companies estimated that their pension plans were overfunded. Therefore, they eliminated the company's contribution to the plans, thus boosting profits. When the market suffered a sharp decline in 2007, 2008, the companies discovered that their plans were actually underfunded, and what investors assumed were sustainable profits turned out to be transitory. Okay. How did Motorola, Lucent, and Nortel boost sales and earnings? They did this by... Oh, thank you. So they did this by lending lots of goods to its clients and what do you call? Writing it down as revenue when in most of these accounts did not get paid back. So a major problem that the analyst has in interpreting current and projecting future earnings is the tendency of companies to report so-called pro forma or adjusted earnings as opposed to actual earnings computed in accordance with general accepted accounting principles. In pro forma earnings, companies decide to ignore certain costs that are considered unusual. In fact, no rules or guidelines exist. Adjusted earnings are often referred to earnings before all the bad stuff, and gives firms license to include any expenses they seem to be special, extraordinary, and non-recurring. Depending on what expenses are considered to be ignored and what revenues are recognized, companies can report a substantial overstatement of earnings. Small wonder that security analysts have extraordinary difficulty estimating what earnings are likely to be. Okay, so I'm going to say I'm going to skip ahead to the last part of the chapter because I don't have that much time left. Kind of see what his conclusion is. The academic community has rendered its judgment. Fundamental analysis is no better than technical analysis in enabling investors to capture above average returns. Damn. Nevertheless, given its propensity for splitting hairs, the academic community soon fell to quarreling over the precise definition of fundamental information. Some said it was what it is known now, others said it extended to the hereafter. It was at this point that there began as the strong form to the... It is at this point that what began as the strong form of the efficient market hypothesis split into two. A semi-strong form says that no public information will help the analyst select undervalued securities. The argument here is that the structure of market prices already takes into account any public information that may be contained in balance sheets, income statements, dividends, and so forth. Professional analysts of these data will be useless. The strong form says that absolutely nothing that is known or ever even knowable So the strong form says that absolutely nothing that is known or even know about a company will benefit the fundamental analyst. According to the strong form of the theory, not even inside information can help the investors. The strong form of the efficient market hypothesis is obviously an overstatement. It does not admit the possibility of gaining from inside information. Nathan Rothschild made millions in the market when his carrier pigeons brought him the first news of Wellington's victory at Waterloo before other traders were aware of this victory. But today, the information superhighways carries news far more swiftly than carrier pigeons. In Regulation FD, fair disclosure requirements, companies to make prompt public announcement of any material news that may affect the price of their stock. Moreover, insiders who do profit from trading on the basis of non-public information are breaking the law. The Nobel laureate Paul Sampson summed up the situation as follows. If intelligent people are constantly shopping around for good value, selling those stocks they think will turn out to be overvalued, and buying those they expect are now undervalued. The result of this action by intelligent investors will be to have existing stock prices already have discounted in them in allowance for their future prospects. Hence, to the passive investors who does not himself search for under an overvalued situation, there will be presented a pattern of stock prices that make one stock about as good or bad a buy as another. To that passive investors, chance alone would be as good a method of selection as anything else. This is a statement of the efficient market hypothesis. The efficient market hypothesis, the narrow, weak form of the EMH, says that technical analysis looking at past stock prices cannot help investors. Prices move from period to period, very much like a random walk. The broad, semi-strong, and strong forms state that fundamental analysis is not helpful either. All that is known concerning the expected growth of the companies in earnings and dividends, all of the possible favorable and unfavorable developments affecting the company that might be studied by the fundamental analyst is already reflected in the price of the company's stock. Thus, purchasing a fund holding all the stocks in a broad-based index will produce a portfolio that can be expected to do as well as any managed by professional security analysts. The EMH does not imply, as some critics have proclaimed, that stock prices are always correct. In fact, stock prices are always wrong. What EMH implies is that no one knows for sure if stock prices are too high or too low. Nor does EMH state that stock prices move aimlessly and erratically and are insensitive to changes in fundamental information. On the contrary, the reason prices move so randomly is just the opposite. The market is so efficient, prices move so quickly when information arises, that no individual investor can buy or sell fast enough to benefit. And real news develops randomly, that is, unpredictably. It cannot be predicted by studying either past technical or fundamental information. Even the legendary Benjamin Graham, heralded as the father of fundamental security analysts, reluctantly came to the conclusion that fundamental security analysis could no longer be counted on to produce superior investment returns. Shortly before he died in 1976, he was quoted in an interview in the Financial Analyst Journal as saying, "I am no longer an advocate of elaborate techniques of security analysis in order to find superior value opportunities." This was a rewarding to say 40 years ago when Graham and Dodd was first published, but the situation has changed. Today, I doubt whether such extensive efforts will generate sufficiently superior selections to justify their cause. I'm on the side of the efficient market school of thought. And Peter Lynch, just as after he retired from managing the Magellan Fund, as well as the legendary Warren Buffett, admitted that most investors will be better off in an index fund rather than investing in an actively managed equity mutual fund. Buffett has stipulated in his will that cash from his estate will be solely invested in index funds. Smart beta, risk parity, and ESG investing. That could be an interesting. Okay. New investment technology. What is the weak form of the EMH? So, the weak form of EMH says that technical analysis is dog water, but fundamental analysis is not. What is the semi-strong of EMH? The idea that both technical analysis and fundamental analysis is dog water. So the idea that both technical analysis and fundamental analysis are dog water. All prices reflect public information. what is the strong version of the EMH. So I think this is the idea that technical, fundamental, and even insider information has no use in predicting future trends. Okay. What does Burton McKeel believe about technical and fundamental analysis? Why? He believes that both technical and fundamental analysis are pretty much useless. There has been lots of academic research about performance of actively managed funds, and they performed worse. And most of them performed worse compared to a passively managed index. Even famous investors like Ben Graham, Warren Buffett, and Peter Lynch favored passive investing over active. Okay, so it's 33. I kind of want to see the idea of smart beta funds in practice. Okay, so there's smart beta, and then there's also risk parity. I'm gonna take a quick dive to this, and then I will end the stream here. I might just read kind of to myself, so I can kind of speed through here. Damn. So the idea is that relatively safe assets provide higher returns than are appropriate for their level of risk, but riskier assets can be relatively overpriced and return less than they should. Investors can therefore improve their results by leveraging low-risk assets, buying them with some borrowed money so as to increase their risk and return. only about 5%. So it isn't entirely clear. I asked ChatGPT for some answers, and I'll call it here. So you're diversifying risk instead of capital. Like many investment strategies, risk parity generally focus on long-term investment horizons. It is less about capitalizing short term. What is the idea of smart beta? Okay, so right there. Alright, so this is what ChatGPT says. It's kind of this middle ground of So it is some type of middle ground for passive and active investing is the idea of smart beta, where you kind of build these indexes based on specific factors. Okay. And then risk parity, I think, is constructing a portfolio allocating risk instead of capital, and also maybe using leverage to increase the exposure to risks to less risky assets. Okay, those are the main ideas. So I think I'm gonna end the stream now, and probably continue back a little bit later in the day if I have some time. But gotta work on some schoolwork now. So I'll catch you guys in the next one. Peace.